I'm going to compare over 18 money market mutual funds and similar ETFs to try to find the best ones for the various categories. And I'm going to crown winners for each category. The categories are going to be Best Treasury Money Market Fund, Best Treasury ETF, Best Treasury and Government Obligations Money Market Fund, Best Corporate and Government Money Market Fund, and the Best Corporate Money Market ETF. Please like and subscribe. It really helps the channel. Okay, so the first group of money market funds I'm going to look at are strictly Treasury-only money market funds. These are funds that hold just U.S. government treasuries or treasury bills. They have no repurchase agreements. So it's the simplest form and the least amount of risk. There's less parties involved. It's much simpler. And if there's issues in the repo market or disruptions or swings in the repo rate, unforeseen problems, these are unlikely to be affected as much as the ones that they have the repurchase agreements. So the first one I want to look at is the Schwab US Treasury Money Market Fund Investor Shares. It's the largest out of all three of these I'm going to compare. It has 16 billion assets under management, a 0.34% fee. The average maturity date is 16 days. Here you can see the yield. So it's 4.28%. Now this is without the compounding. This is with the fees reduced, but without the compounding. So with the compounding, it's probably 4.37, something like that. Year-to-date performance around 1%. Now when we look at their holdings, you can see here, Treasury, US Treasury debt, US Treasury debt. There's no repurchase agreements, nothing else. So very simple. This is around, most of these have around 20 holdings, 20 to 30. The next one is the Fidelity Treasury Only Money Market Fund. This is one that a lot of people are probably not aware of because it's one of the smaller ones. It's only got about 4 billion of assets under management. It has a 7-day yield of 4.16%. Year-to-date return 1.23% on this one. The net expense ratio on the Fidelity one is 0.42, so it has a higher expense ratio. The portfolio, 95% US Treasuries, 5% Treasury coupons. You see here where it says repurchase agreements, nothing. Average maturity in days, 23 days. Before taxes, the 1 year is 2.27% return. The next one I want to look at is actually one of the highest yields. This is one I usually don't compare Gabelli because they have higher fees. Now most of their funds, the fees are like almost 1% or higher for most of their funds. That's why I was surprised that this was rated best of 2023 by Forbes. Now this one, it's called the Gabelli US Treasury Money Market Fund, Class C. Now they have different classes, so the minimum investment on this one is $3,000 for a non-retirement account. The 7-day yield is 4.72%. Now this one has no sales load, but there are some fees that you should be aware of. This one has 3.62 billion of assets. The year-to-date returns 1.1, 2.5% 1-year return. Now, when we look at the Gabelli US Treasury Money Market Fund, it's like all the other ones. It's only US Treasury. So you see a US Treasury. This is only like one page or so. And they do have some floating rate notes here, you can see, but not a huge amount. Now, as far as the expenses go, it looks very good. It's actually one of the lowest expense ratios, only 0.08% expense ratio, but that's deceptive. So when we look here, we're looking at Class A and Class C. That's the one most people are going to be in. Now, there's a maximum deferred sales charge load of 1%. Deferred sales load means they're going to charge you when you close the fund, I believe. When you look at the one here, this shows none, so they're not going to charge you initially, but when you go to close the fund, they're going to charge you 1%, which is huge. Now, there's actually also a redemption fee. If you look here, a redemption fee, $5. I guess that's per account. There's also a closeout fee. Closeout fee, $5. So you've got $10 right there, $10 plus 1%, and then plus the 0.08%. So that's why I would say this is not a good one anymore. I mean, it did look good on the surface. Actually, you could probably make this 1.08% plus a little bit more, which makes it outrageous. Okay, so Gabelli US Treasury Money Market Fund, I did a quick look into this. All of these classes, this fund is closed to new investors. Now, I looked on E-Trade, I saw nothing except the AAA one, and it wasn't clear if it was a $3,000 initial investment. It says here $3,000 when you select the AAA one, but then right above there it says $10,000 minimum. When I actually put it into E-Trade, it said $10,000 minimum, not the $3,000 here. So it looks like $10,000 is the minimum. When I put this in Fidelity, all of these said closed to new investors. So it says nowhere here on the website that it's closed to new investors. So they're a bit of a time waster. But anyways, no matter how you look at it, this one's not good because of the fees. The 0.08 fee would be great if that were the only fee, but the other fees is really what ruins it. For example, if we factor in this $5 and the $5, that's $10. $10 into 1,000 is 1%. So per each, if this were a $1,000 investment here, that's 2%. This would be 1%. This would be 2%. 2.08%. If you held it for just a year and sold it, I believe. Now this one is a $10,000 minimum. Now, if you just factor in the $10 into that, if you just factor that 10 into 10,000, that's not going to be quite as bad for this one. But regardless, it's close to new investors, and it's going to raise the fee up. And the question is, what happens if you were to sell a little bit at a time? If you're selling little chunks of this at a time and you're getting charged $5 each time, you're getting charged $10 each time you sell a small chunk of the fund, it's just not worth it for me. I don't have enough time to look into all the fees with this one. With Vanguard, Fidelity, or Schwab, you don't have fees like this. The winner for the US Treasury only's money market mutual fund is Schwab. The Schwab US Treasury Money Fund investor shares, ticker symbol SNSXX. The expense ratio on this one was 0.340. It has the highest yield out of all of those. I'm also going to compare the ETFs right after that, and you'll see that they hold similar securities, but the yields are much higher. Stay tuned for that. The first category that I had was strictly US Treasuries with no repurchase agreements, and Vanguard Treasury Money Market Fund was excluded for that because it lists under the portfolio composition, it lists that there's actually repurchase agreements. Under the portfolio composition, it shows that there's repurchase agreements, which could be with banks, and there could be issues with that if the market starts to turn sour. Under the portfolio composition, you can see it's 51% Treasury bills, but you also see that there's repurchase agreements of 41.5%. But there is more to it than this. This is not with banks, and I'll show you. It's with the Federal Reserve Bank of New York. So you don't get much better than that. I mean, this isn't a private bank. This is a Federal Reserve Bank. So obviously, if there's going to be problems with that, the government would take care of it. It's not something to worry about. And everything else that they have are Treasury bills. So I would move this up on the hierarchy to a higher level. Yeah, I looked at the complete list here. Federal Reserve Bank of New York, that's the only one you see listed for the repurchases. So I'm going to actually put this as the winner for the category of Treasury only. The Federal Reserve Bank of New York is good enough for me. I wouldn't be too worried about it. So this one has a 4.72% yield. So 4.72% yield versus a 4.29% yield with the previous winner, which is Schwab US Treasury Money Fund. So Vanguard blows this one away, blows the Schwab one away. So I'm going to crown Vanguard as the winner for this category. Okay, so the next group of mutual funds that I'm going to show you are the money market mutual funds that are US Treasuries, Treasury obligations, and repurchase agreements. So it could be a combination of all those, but not just strictly Treasuries. This one has quite a few, so I'm organizing this from lowest yield to the highest yield. So the first one is the lowest yield, and the first two are Fidelity funds, so they're the lowest. So we have the Fidelity Treasury Money Market Fund, FZFXX. You're probably familiar with this if you have a Fidelity account. It's one of the two that you can choose from, either this one or SPAX. The yield on this one is, the 7-day yield is 4.46%. Now that doesn't include the compounding, so it's going to be a little bit higher than that once you factor that in. The expense ratio on this one is normally 0.42, but recently they lowered it to 0.28. This one has $35 billion in assets under management. The year-to-date return on this one is 1.02%. Here you can see the portfolio breakdown. It's mostly repurchase agreements, 91%, with some treasuries. $40 billion in assets under management. Okay, let's look at the next one, the Fidelity Government Money Market Fund. This one is also known as SPACs. It's one of the 3 options that Fidelity gives you to select from. So it's very easy to select this one. This one is the more popular of the 2. It has a yield that's slightly higher at 4.48% 7-day yield. It has a very similar return year-to-date, 1.02%. This one has a 0.42% net expense ratio, so a little bit higher, but the performance is better even after fees. When you look at the portfolio composition on this one, it's a little bit different. It's government repurchase agreements, 65%, but then there's also agency floating rate securities, fixed rate securities, US Treasury coupons, but these are all government agencies, so no corporate stuff in there. Now the weighted average maturity on this one is a little bit longer at 17 days. The other one was actually 1 day, which is really low. So the next one is the Schwab Government Money Fund Investor Shares. It's also known as SWVXX. It has a slightly lower fee of 0.340%. It's a little bit of a smaller fund. It's $15 billion under management, but still sizable. Now the 7-day yield on this one is 4.50%. The weighted average maturity is 14.9 days. The year-to-date returns very similar, 1.02. When we look at the holdings for Schwab, it's a lot of government repurchase agreements. You have repurchase agreements with a bunch of different banks, but it's all US Treasuries. You also have government agencies like Federal Farm Credit Bank. That's guaranteed by the government also. Federal Home Loan debt. The next one is the one you're probably, if you're a Vanguard customer, you're probably familiar with this one. It's the Vanguard Federal Money Market Fund. This is the default cash sweep option if you have a Vanguard brokerage account. Now it has a 0.11% expense ratio, and the yield is a little bit higher. Now you saw the other one, the compounded yield was 4.7 something. This one, the 7-day yield is 4.76. So the compound yield is probably 4.8 something. Now we look at the year-to-date returns on this one, 1.37, a little bit higher. And there you have the compounded yield, 4.87. So that's basically similar to what your APY would be with a savings account. Average maturity, 14 days. Number of holdings, 144. So you've got a number of holdings in this one. 238 billion under assets under management. So this is one of the larger ones. The next one is one that's almost identical to the previous Vanguard fund, but it has a slightly lower fee and a slightly higher yield. So it's a 0.10% expense ratio, 4.78% SCC yield, 7-day yield. Now, this one has a disclaimer up above that says that you can't get check writing if you have this one. Year to date, 1.37, so a little bit higher on this one. 4.89 compounded yield for 4/20 of 2023. So that's pretty high. As you look at the details here, it's almost the same. Average maturity, 14 days, 141 holdings. This one is a little bit smaller, 101 billion of assets under management. When we look at the details here, you can see it's mostly repurchase agreements and US government obligations, so very similar to the other one, I think. Now, when you look at the market value of most of these money market funds, I won't spend too much time on it, but they're all priced at $1, and they very rarely stray from that. That's their goal, is to keep it at $1. That's the benefit of the money market fund, is that you can sell it. You're always selling it at $1. You can do a market order and not have to worry about it going up or down too much. You're always going to be at the same price. The interest is paid out, monthly. That's a separate thing than this. Here you can see the dividends or interest that it's paid out. Okay, when we look at this here, it's almost the same. It's a lot of federal farm credit debt. You've got Treasury repurchase agreements. Here's one with the Bank of Canada. So out of all of these, for this group, which one is the winner? I would say that the Vanguard Cash Reserves Federal Money Market Fund, Admiral Shares, is the winner. It has the 4.78% yield. It has a lower expense ratio, and when you factor in the compounded yield, 4.89%. So that one is slightly higher than the default Vanguard sweep option. So I would say this is the best one for this category. Okay, so the next category is Treasury only ETFs. So this would be basically the equivalent of the mutual fund. Of course, you don't have the same $1 net asset value price. The price on these is going to fluctuate. So that's the downside, but you do have a lower expense ratio, and the yields are often higher than what a lot of the mutual funds for this category. So I'm going to sort these from lowest yield to highest. The first one is the iShares Short Treasury Bond ETF. Now these are short treasuries, but it's less than 1 year, but I don't think they're quite low enough, and you'll see that here. The expense ratio is a low 0.15%. As you remember, the Schwab one was 0.34%, so that's less than half of the fee. Exposure to US Treasuries with maturity of less than 1 year. We look at the 1 year return, 2.2. This pays every month. It pays the dividend or yield every month. This is another downside of ETFs, is that there's a premium or discount from the net asset value. When you buy a mutual fund, you don't have to worry about that. You're going to get it at the net asset value. But with an ETF, you could overpay or underpay. And you can see here, most of these Treasury ETFs, they have, at least in 2022 or 2023, they've had a premium for more days than they've had discounts. And you can see here, 0 is what you ideally would want to buy it at, or a discount. But you see that most of this is above the 0 here, most of the year. 23 billion in assets under management for this one. 23 holdings. The 30-day SEC yield is 4.6%. The average yield to maturity on this one is 4.3%. The weighted average maturity is 0.29 years, so roughly 1/3 of a year, so roughly 3 months. Now when we look here, you can see all of the stuff that they're invested in. So it's Treasury bill, Treasury note. Okay, so remember this one. This one was 4.6% SEC yield. The next one is also from iShares. It's the iShares 0 to 3 month Treasury bond ETF, also known as SGov. This one has a super low expense ratio of only 0.05%. This one seeks to track the index composed of US Treasury bonds with maturities of less than or equal to 3 months. The total return on this one is even higher for the 1 year, 2.66%. This one has 9 billion in assets. Just like the others, this one pays monthly. And this one has a 4.69% yield, 30-day yield. Now the other one was 4.60, so this is roughly 0.1% higher SEC yield. The average maturity on this one is 0.10 years. So the other one was 0.3. So this one is lower by about 0.2 years. This one is a shorter duration of about 2 months. Okay, now when we look at the holdings for this one, you can see Treasury bill, not very many holdings either. So that's it, all right there. So the next one is WisdomTree Floating Rate Treasury Fund, also known as USFR. I believe the FR stands for floating rate, not fixed rate. Now, when we look at this one, it has a low 0.15% expense ratio. The weighted average coupon now on this one is 5.22%, so that's really high. The 30-day yield on this one is 4.86%. Distribution yield 4.69. Now this one does have a premium most of the time of 0.05%. As you can see here, you go back a few days, most days it's around 0, 0.03, 0.02, 0.04. You don't see many negatives in here, so most days it's trading at a premium. And as you look at this one, the 1 year return is 3.10%. Now with this one, the price goes up and down. It's not like a money market fund where the price stays at $1. So you will notice that the price creeps up, and I'll show you that in a little bit. Okay, let's look at the next one. Okay, let's look at the holdings for the WisdomTree Floating Rate Treasury Fund. You've only got 4 holdings. So it's US Treasury floating rate notes, and that's what makes these so special, is the rate adjusts every week. The next one is the iShares Treasury Floating Rate Bond ETF, TFLO. I own this one and the previous one. I've got shares, and they're almost identical. I think the other one had 6 holdings. This one has 8 or 4. They just hold Treasury floating rate notes. It's got some more floating rate Treasury notes, but you got 1, 2, 3, 4, 5, 6, 7, 8 floating rate Treasury notes. Now the SEC yield on this one is 4.88%, so even 0.01% higher than the previous one. The average yield to maturity on this one is 5.31%. So if the rate stayed the same and you held these floating rates to maturity, which is I believe 2 years, then it would be 5.31. But of course this isn't gonna happen because the rate could go up or down. That's the downside of this. And this average maturity doesn't matter because it adjusts every week. Okay, so let's do a comparison between the Treasury ETFs that I've selected. Now you have TFLO, which is in orange here. Now this is the 3-year return. I'm going to give you the far out view, and then I'll start zooming in. So you can see TFLO, just the price return for the 3-year. Out of these 3 or 4 that I selected, it's near the top. And then now this is just the return. It doesn't include the monthly dividend or interest that it pays. SGov was the close second, slightly behind TFLO, but it has a lower yield. So you're getting a lower yield. So overall, I would say this is going to be a lower return. And then we have SHV. This is supposed to be the SHV is the iShares short bond ETF. Now it has a 2 months longer duration than SGov does. So as far as long term, this is the longest. Then next would be SGov, and then these two would be the shortest term. And you can see that in the price. So if you look at the 3-year, you can see here in green just how much it didn't, it's nothing like stocks, but it went down 1%. If you're looking to put your money in a savings account or something that's safe, you'd hate to see that your money goes down 1%, in a short period of time. And that's kind of what this did. Now let's look at the 1 year. Now we have TFLO. As far as the, if we look at the numbers here, the best performer for just the price was SGov at 0.48. TFLO was number 2, and then SHV, and then USFR. And as you'll notice, unlike money market mutual funds that have a straight $1 net asset value, these go up and down. So every time there's the announcement for the dividend, and then the ex-dividend date is the date that they pay out. So if you own the stock, if you own it that morning that the market opens, you'll get the dividend. So you see here the peak is before that, and then it bottoms out at the ex-dividend date. And these are staggered. So USFR has a different ex-dividend date than iShares does. iShares does theirs around the same. So you'll see that they're staggered a little bit. Okay, so that's the 1 year. Let's do the total return. Now I did have a little bit of a problem with the total return. I don't know if it's working properly. You'll see here that it shows that TFLO is, underperformed everyone. Everything was fine until I just selected the total return, and then you see that it dropped. So I think maybe the way this thing calculates the interest payments or the dividends, maybe it missed one. That's why you see this drop right here. When you look at the price chart, it doesn't show anything. And as far as I know, the interest rate hasn't dropped or anything unusual recently. Now when we look at the 1 year total return, it's actually showing that SHV did better. Now SHV has a lower yield. It has the lowest yield out of all of these. So let's look at the year to date. I don't really trust this total return thing so much. I think the reason the total return was better for this one, during the 1 year going back, basically TFLO and USFR were paying next to nothing until around 2023. So this is where they were making their money. The longer term ones were doing better, and it just averaged out better. But if we look at the year to date, that's the most important thing for me to look at. That's when the interest rates really started to go up. So starting around January, and this is when everybody started shopping around for savings accounts, high yield savings accounts. If we look at this one, it's showing that, let's just do the price return. For the year to date, for just the price return, TFLO, SHV is showing number 1. And I think this is a little bit of a fluke, and I'll show you here in a little bit. Number 2, it says SGov. And then you have TFLO and USFR as the next ones. Now, when we include the total return, this is the one where I have a problem with. I think it missed something with TFLO because it's showing that it's like, it should be about 0.4% higher than that. So I think there's probably an error in however it calculates the total return. But if we look at the number one is USFR. So like I've been saying, the floating rate ones tend to do best during this fast rising interest environment. Number 2, SGov is also a pretty good one. It's 1.4%, so it's not too far behind. And then this one is number 3, SHV. However, I'll show you that it just spiked recently after the Silicon Valley Bank collapse. All of the long-term bonds went up, so I think this is artificially high right now. I've added a couple other longer-term ones. So you have this chart that you see at the very bottom is the Schwab Ultra Short Bond, and you also have a Vanguard Ultra Short Bond. And you can see these went down almost 2.5%. This is just 1 year. They went down almost 2.5%, whereas the floating rate and the shorter term ones, they're more stable. The next, so basically as far as these are the longest term. Then as you move up, you have SHV, which is the iShares, the shorter term, the one that's the longest of the short term bonds here. And then you have, so TFLO is in black. This is the 1 year, just the price. TFLO is in black. You'll see that it returned around 0.3%. This is going back, when interest rates were really low. So I'm going to look at just the 3-month. But even with the 1 year, this is showing that even the 1 year, it's showing that TFLO and USFR, I mean, they're near the top. SGov is up there also. So let's go and look at just the 3-month. Now when we look at the 3-month, which is probably the most important one, or year to date is probably will work also. If we look at the year to date, you can see how these long-term ones, they're not really suitable as a money market type replacement because their prices go up and down too much. If you notice right here, the longer term ones, this is around 3.9. Do you know what happened on 3.9? This was March 9th. You see that the prices were down low, but then they spiked up. This is the date that Silicon Valley Bank, the stock price went down 60% in 1 day. So this is the start of that whole mess. And everyone starts speculating that the government is going to stop increasing interest rates. And so the long-term bonds shot way up. Now, I think that if this continues and they see that the next quarter, whatever data comes out and it shows that the economy is still running too hot and that the Fed's going to raise rates again, these are probably going to go down again. So I think this is temporary. And also SHV, which was one of the longer term ones, it went up with it also. If you look here, this is around the same time. Look at the purple one here. And it spiked up. It spiked up and it's kind of kept that trend. So it's kind of artificially high right now. And I think that there's a good chance that when the data comes in, the economy is still too inflated. If the Fed keeps increasing rates, you're going to see this will drop down again. So for me, just a place to put money, the best thing is the short term, an ultra short term money market account. And a lot of times the ones that say they're ultra short, they're not really. But TFLO and USFR, they're ultra short. I did notice something about TFLO and USFR that differ, and they're not all equal weight. So you've got 19%, 14%, 13%. So you have staggered percentage weights, and some of these are going to mature or pay out at different times. And so it seems that TFLO, their dividend or interest payment this last in 2023, it's not all incremental. So there are some months where it pays more than other months, and I think that has to do with their weights, how they hold the different percentages of the floating rate notes. Now, when we look at the distributions for TFLO, you can see November of 2022, 13 cents a share. Then December, each month, so it's going up 17 cents a share. Then December, it went down 16 cents a share. February, 19 cents a share. March, 16 cents a share. And then 18 cents a share for April. So maybe that's one reason for the issue with the total return being showing down. The next month or two, it may overperform over USFR. Now, when we look at WisdomTree USFR, you'll see that they only hold 4 floating rate notes, and it's all equal weight. So when these payouts happen, it seems to be more equal than what TFLO has. Now, when we look at the distributions for USFR, you'll see that in January of 2023, 18.5 cents a share. Then the next month, 18.7, then 19.7, and then 20.5 for April. So if you want something where the interest goes up incrementally, perhaps USFR is a better option. So which is the winner for the best Treasury ETF? I have a chart here, that's the price chart showing USFR and TFLO. TFLO is in red. As you can see, the TFLO price drops up and down a lot more than USFR. When you look at it, the price is more stable. It doesn't go up and down as much. And I think that's a direct relationship to the incrementally increasing dividend price that USFR has. As a result, I'm going to give the edge to USFR, WisdomTree Floating Rate Treasury Fund, USFR, because the price is going to be more stable. The dividend or interest payments are going to be more predictable. When you're buying over time and the price creeps up, it's not going to drop down 1 month. It's just going to incrementally go up slightly, and it's going to be easier to price out when you go to buy it at a slightly higher price after a few weeks or months or whatever. Although before I would say they're equal, I'm giving the edge to USFR now. So the last group of money market mutual funds that I'm going to include are basically government and corporate paper backed money markets. So these are basically the riskiest type of money market funds. Now the first one, I've got 2 of them here, and the first one is the lowest yielding. It's the Fidelity Money Market Fund. The ticker symbol is SPRXX. It has, like most of the other Fidelity funds, it's net asset value $1. 7-day yield 4.55%. So it is higher than SPACs. It's higher than the other ones, but also the risk is higher. It has the same 0.42% fee, just like the other funds. However, when we look at the composition of the portfolio, it's U.S. government debt, only 0.12%. It's got bank CDs, 7.91%. It's got asset-backed commercial paper, 61% U.S. Treasury repurchase agreements, but you have 15% commercial paper from financial companies. And financial companies are probably going to struggle during this downturn. So actually, as far as the popularity goes, these corporate money market accounts, they've actually seen outflows in money. Whereas all the other ones I've looked at, the government ones, they've all been seeing, since a month or two when I did that video, they're, several billion more for each account. This one is probably gone down. 77 billion in assets under management for this one. The next one is the Schwab Value Advantage Money Fund, investor class, SWVXX. The expense ratio on this one is lower at 0.34%. This one invests in high-quality short-term money market investments issued by U.S. and foreign issuers. This one has 115 billion of assets under management. This is considered a prime money market. Now, the 7-day yield on this one is 4.67%. So it's higher, but it's still not as high as what Vanguard had. Vanguard has the government ones that are higher than this, and you don't have the risk. You don't have all the risk. Average maturity of this, 13 days. Year-to-date return on this one, 1.1%. The portfolio on this one, the portfolio on this, you'll see there's asset-backed commercial paper. There's quite a bit of that. Now, I'm guessing if there's another financial problem, all this commercial paper, the values are going to go way down, and this is going to be impacted. If they don't, some of these may get wiped out also. You have bank CDs, Citibank. You see there's a lot of financial companies. Actually, I see more of this than I do anything else. Yeah, as you can see, there's a lot of stuff to look at and think about as far as risk. So I'm not interested in this one at this time, especially now that we're going into a recession and these rates are going to be going up and a lot of these companies may be failing. There were several banks that failed during the 2008 recession. A lot of banks failed. Okay, so let's compare the 4.67. This was the 4.67 from Schwab for the corporate money market fund to the top Vanguard money market fund with the highest yield. This one is 4.78%, the VMFXX, and these are all government agencies with low risk. Also, if we want to be even more risk averse, we could do the Vanguard Treasury Money Market Fund. This is the one that instead of 4.67, you have 4.62, but you've got way less risk. So you're not likely to lose any part of your portfolio because it's all backed by the government, unlike the other one. So the returns in the long run may be better with this one because the portfolio is not going to be deteriorating like the other one. So if the 4.67 starts deteriorating, the yield could be less than this one. The last category of something that would sort of work like a money market account, that's the ETF. It's probably my least favorite at this time. It's actually the floating rate, corporate bond floating rate ETFs. So I have two of them here. One is the iShares floating rate bond ETF called Float, FLOT. I actually have some shares in this one. Now, these are the highest yielding, but they're also the riskiest. And I think a couple of the holdings on this account got wiped out recently. If you look at this right here, exposure to Credit Suisse, I don't know how you say that, and UBS. Now, I know that the Credit Suisse, or however you say that, they had something like 17 billion of debt that got wiped out. Now, actually, this fund, the floating rate bond ETF, as you see right here, had 1.32% of assets with the Credit Suisse. And then the UBS, it had 1.54%. Now, I think that got reduced or it was impacted in some way. This ETF has a low 0.15% expense ratio. This is basically short-term corporate debt. It's a short-term investment-grade floating rate bonds with maturities between 1 month and 5 years. If we look at the total return, the cumulative for the year-to-date, 1.37. So it's at the high end, but the price is all over the place compared to the others. And as far as the premium discount goes, now this was selling at a premium in 2022, but now you see that there's more recently after all this bank failure stuff. Now you see that they're selling at a discount, and actually it was selling at almost a 2% discount on March 15th, shortly after the SVB failure. The average yield to maturity on this one is 6.04%. The 30-day SEC yield is 5.74%, so pretty high. Weighted average maturity is 1.76 years, so it's not the shortest. Let's look at the kind of holdings they have. They have Goldman Sachs, JP Morgan. They list all the big ones at the beginning, but then there's a lot of smaller ones in there too. You have Verizon, HSBC. Now, once you start getting into it, you'll see a lot of these riskier companies. Bank of Nova Scotia, Citigroup, Asian Development Bank, and there's a huge list of companies they have. Nissan Motor, Caterpillar. The next one that we're going to look at is the SPDR, Bloomberg Investment Grade Floating Rate ETF. It also had the assets under management decline. I think these were the only ones out of all of them that I compared a few months ago that actually their assets under management dropped, from the last time I did it. It's got the same 0.15% expense ratio. This tries to track the performance of the Bloomberg US Dollar Floating Rate Less Than 5 Years Index. This has 348 holdings, average maturity 1.8 years, average yield to worst 5.88, average coupon 5.3. The 30-day SEC yield is 5.7%. As you can see here, the price dropped quite a bit. 310 was the day after SVB stock went down 60%. You can see that it dropped quite a bit at that point. Now it's back up now, but it's still below what it was before the SVB failure. So it's not the best thing right now. Year-to-date return is 1.41, so it's one of the highest ones. Now, when we look at the companies they're holding, it's more of the same, corporate debt. So you've got HSBC, Asian Development Market. The top 10 holdings are just like the other one. It's the same big companies. But you have Goldman Sachs, HSBC, European Bank. Here you can see mostly corporate debt, utility. You have some utilities. Here's the index quality, so it's not all AAA. Most of the debt is 1 to 3 years or 0 to 1 year. They do have some longer stuff also. Okay, so let's compare this now as far as the price goes. So if we look at this here, FLOT is this green one you see, and FLRN is the red one. You can see that the price dropped more than any of the other ones. Now, I threw in Vanguard Ultra Short Bond, which is more of the longer term bond. It was the one that looked like it was all over the place before, but when you compare it to these floating rate corporate bonds, they're a lot more volatile than even that one. If we go back 1 year, you can see the Vanguard one, which has the duration risk because it's a longer term. It was down around 1% here. But you look at this floating rate, it went down to 2%, during that SVB right after their collapse. Let's do the year to date and see what it is with the total return. Now, the total return is still one of the highest. Both of them are higher than US floating rate. That's basically the same as TFLO, which was 1.4. So it's still returned a lot, but there's a lot of risk that you're taking on. And a lot of people are saying, just like right here when it went down, the next time, if you really wanted to get into this, wait for the market to collapse again. The next thing that happens when it drops, if it goes down another 2% or 5%, then maybe consider it. That's probably what I'll do, because not all those companies are going to fail, but it's only a small percentage. It's only a small percentage yield. It's not like you're getting 5% more yield for the risk. The Yahoo price gives you a better look at the price. So we have the Vanguard long term, which is the black one here. You can see it's all up all over the place. You've got the duration risk of the longer term, but you can see that the pink one, FLOT, and the green one, they shoot up quite a bit and they shoot down quite a bit. If you're just looking to lock your money away, it's definitely not something that would be good for like a money market. It's something that is going to be a lot riskier, up and down more. Now here's the year to date. This may give you a better idea. So you can see here actually FLOT and FLRN, the pink and the green, they were doing pretty well until the SVB failed, and then it dropped like 2%. And then now it's up, but it's less than what it was just, a month or so ago. So it definitely was impacted. And then you look at TFLO, it's just chugging along. It's not, it doesn't really go up or down that much. So I would say between these two, if you really wanted to do the corporate bond floating rate, they're both basically about identical. I don't think either one, they're both the same expense ratio. I can't tell which one is better. They both seem the same to me. So the winner for the best Treasury money market mutual fund goes to Vanguard Treasury Money Market Fund. It has the lowest expense ratio and the highest yield. Best Treasury ETF goes to WisdomTree Floating Rate Treasury Fund. It has a 4.87% 30-day yield. It also has a very predictable and increasing dividend payment. The best Treasury and government obligations money market mutual fund goes to Vanguard Cash Reserves Federal Money Market Fund. It has the lowest fee and the highest yield. The best corporate and government money market mutual fund award goes to Schwab Value Advantage Money Fund. It has a high 4.67% 7-day yield. The award for the best investment grade floating rate ETF goes to SPDR Bloomberg Investment Grade Floating Rate ETF. It has a slightly higher total return and a high yield of 5.7%. Thanks for watching. I hope you liked this video. It takes a long time to do these videos. If you like this video, like and subscribe. It really helps.